Assalamu alaikum viewer, welcome to my YouTube channel. Today my topic is mortgage residential versus commercial. Both residential and commercial mortgage share some common characteristics including that lender take property as collateral. They generally require an appraisal and both typically have a more favorable loan structure than other types of credit. But there are also some important differences that make them unique. Residential mortgage some key characteristics include the property is often occupied by the borrower, meaning is it's their primary residence. The borrower is typically an individual or a married couple. The borrower is usually servicing the mortgage with their personal earning and must therefore be able to prove they have a stable income, provide evidence of any other valuable outside assets, and demonstrate a good credit history. Residential properties tend to have very active secondary markets and therefore generally support higher LTVs, loan to values often up to 95%. Commercial mortgage. Some key characteristics include the borrower is generally a company such as corporation or a partnership, although individual can still own commercial properties. The borrower is not servicing the mortgage with personal earning cash to service the mortgage obligation comes from either business operation if they run a company on site or rental income if it's an investment property. Understanding the cash flow for a business operation require a much more extensive analysis of the underlying business include its financial health management capabilities and competitive advantage. Understanding default risk for a rental property is even more difficult as the lender will not have access to the tenant's financial information. Commercial mortgage deals for investment properties are analyzed based on the geographic location, the quality of the property, and the strength of the lease agreement, among others. Commercial property tend to have many restrictions on uses and therefore favor prospective occupants. This generally means much lower LTVs, loan to values, more like 50% to 75% mortgage payments. A mortgage payment is made up of two components, interest and principal. Interest rates vary by jurisdiction and other market conditions. The risk of the borrower and borrowing request also influence interest rates. Interest rates are generally either fixed or variable, often called floating. The principal portion of the payment amount goes towards paying down the original mortgage amount outstanding. The original amount outstanding is usually scheduled to be repaid to zero on the last payment of the amortization period, which may be 25 to 30 years.